Spot trading versus futures trading. Ever since I started doing my $3 to $1,000 challenge on Weex, I've been getting a lot of questions regarding like what am I trading, what exactly is leverage, how am I making crazy multiples like that. So I figured I'd do a series of videos kind of explaining the whole process of leverage trading to anyone who's kind of new in the space. Maybe you've bought a couple digital assets here and there on Robinhood or Webull or something like that, but maybe you've never really dove into charts or technical analysis or trading with leverage, right? So this video is pretty much to just answer one simple question, and that's what exactly am I trading? I'm personally trading futures contracts because you can trade with leverage, you can short, you can go long. Of course, there's other options like options, but I'm mainly going to stick to the two main methods of buying and selling positions. So just to start off with this explanation, we have spot positions over here, which are basically like buying an asset and holding on to it and selling it when it goes up. It's pretty simple. So for example, if I were to buy something off of the market, let's just say some Bitcoin for example. If I go ahead and buy like $5 worth of Bitcoin in my spot account, I'm owning that asset. As in, that $5 of Bitcoin is my own asset. I can transfer it out of the exchange if I want to. I can put it on a cold wallet. I can put it on another hot wallet. I can throw it into another exchange. I can do whatever I want with it, right? It's basically buying an asset straight from the market, holding onto it, and basically just doing whatever you want with it. If you're strictly just trading a spot position, your main method is going to be to buy low and sell high. I'm trying to make this video a little quick, so if you guys have any questions about this, please let me know in the comments, but that's basically what a spot position is. Now, when we go over to futures contracts, so right over here, I've got my Solana trade still open. If any of you guys haven't been following my Weex trading challenge, I've been trading $3 into $1,000, and I'm on about day 8 or 9 right now. As you can see, I've got my account balance at up to $80, but I'm still holding on to this position just for a little bit longer before I close out. My account balance though is pretty much down to 2 cents, so I've pretty much deployed every available amount of capital that I could right now, which is not a good idea. But for the sake of this challenge, I'm kind of just going balls to the wall here. Anyway, a futures contract is basically you owning a piece of the asset on paper. So if I were to buy whatever amount of Solana, let's say $5 worth of Solana, let's leave leverage out of it, okay? Let's just say I were to buy $5 worth of Solana futures contracts. All I can do with that futures contract is trade it on this exchange. I can't move that $5 of Solana onto another exchange. I can't transfer it over to a cold wallet or anything like that. This $5 futures contract is literally only on this exchange. Obviously, there's a lot more to it. If you really want to get into what futures contracts actually are, I'll make a more in-depth video in the future. But that's pretty much all you need to know for our purposes here. And now we get into leverage. So one of the main benefits with trading futures contracts is that you can trade with leverage, which is borrowed money from the exchange. If you want a more in-depth analysis, check out this video. But again, it's literally just multiplying whatever position you put in by the amount of margin that you're using. So let's just say if I was to take a $10 short position right here and I'm throwing it on 80x leverage, my $10 times 80 is $800. So I'm trading with an $800 position. If the position stays in my favor, I can hold on to it for as long as I want. But if the position goes against me, as you can see right over here, my liquidation point, by the way, this is a whole different trade. I'm just using this as an example. My liquidation point would literally be about 1% to the upside. So if Solana were to go 1% up, my $10 would be liquidated to zero. But if the chart were to move in my favor and go down, a 1% increase on an $800 position is going to be $8. So hopefully that kind of makes sense. This 1% move down would make me $8. Whereas, if I only held a $10 position, what would that be? About a dime, right? So I'd make 10 cents if I just shorted this with $10 on no margin. Obviously, I would have like way less risk because no matter how much it goes to the upside, I'm not going to get liquidated because I'm not trading on margin. Well, technically you can get liquidated, but it's nowhere close to this kind of a level of a risk. So that's basically it. I wanted to keep this video nice and short. Spot positions are positions that you buy, you hold on to, you sell when it goes up, or you sell, when it goes down at a loss. You can hold on to the position, transfer it around, do whatever you want with it. Futures contracts, you can trade it on leverage, but it's only on the exchange that you buy the futures contracts at. Anyway, guys, I hope this helps. Let me know in the comments if you have any questions or if you have any requests for future videos. Peace.